Hey everybody, John LeTourneau here, Director of Commercial Operations at eXp Commercial. Thank you for joining me for our multifamily product update. Some fascinating things happening in multifamily right now. Some exuberance. Don't get a little ahead of yourselves yet, so let's dig in and see why are we so happy about multifamily right now. Well, first, let's start with vacancy, right? It's at 8.2%. You're going, ooh, John, that's not great. Yeah, it's down from 8.4 and it's heading downward and going to fall below 8% by year end and continue downward. Okay, that's cool. I'm good with that. However, 12-month absorption exceeded deliveries for the first time since 2022. Okay, so there's an appetite. Yes, there is. And deliveries are falling while absorption is going up. As a multifamily owner and investor, those things make me very happy because that means I have rent growth because there's less buildings with more people chasing those. So opportunity and scarcity will drive that up. Now, 12-month delivery. Let's talk about that. It is down. It's to what, 577,000 units or so coming. That's down 30% year over year and will fall further in 2026. People are not spec building massive apartment structures anymore because the market is oversaturated with them and it's just too much risk. Now, the other side of that is, if I'm already an owner and in multifamily, great time to talk about rent increases, rehabbing units, and really taking huge steps up and potentially repositioning assets to get better rent growth out of them. They're saying rent growth is about 1% year over year. That's super average. Some markets are seeing phenomenal growth and others are seeing concessions. So you have to really know your product and your market. Sales volume, $119 billion, which is up 17% year over year. We talked about industrial at 40-ish billion, retail at 60 something. This is 119. So if you talk about an incredible amount of activity in a big segment, but multifamily is on fire as far as transactional activity. Average cap rates are all across the boards, and some are below fours, some are in the 6.5, 7 range. Okay, but we kind of finally hit that turning point on absorption, where absorption is surpassing new deliveries, and that's a huge bellwether for this segment of the market. 4 and 5 stars vacancy is down 10.9, almost 11%. It was 11.8 at peak. So those new deliveries, which are expensive and beautiful, we're a little bit high on the vacancy rate. That's coming down. Our 1 and 2 stars are seeing 5.5% vacancy. So a vast difference, half the vacancy between the two, because people eventually are going, enough. I might not live in the greatest place, but I can afford it. So there's a huge sort of variance there. New York, Dallas, Atlanta, Raleigh, Tampa, all huge absorption numbers. But let's look at our vacancy markets. Where are headwinds or challenges? Challenges, Austin, 14.7%. High vacancy. Memphis, 14.2%. San Antonio, 14.5%. Charlotte, 12%. Long a darling of multifamily investors. A little bit of trouble there when I see 12% vacancy in Charlotte. A little disconcerting. 30 of the 50 top metros saw vacancy declines in 25, but the ones that kind of had the challenges are a bit surprising, right? But the peak was 700,000 units constructed, by the way, in Q4 of 2024. Now they're supposed to fall 33%-ish by year end and another 40% in 2026, down to 280,000 units, which is a 12-year low. This is phenomenal news for those who are long-term holders in multifamily, because it's going to take a long time to absorb what's in there and then to come back out of that and then start building again. So you've got a great trough, as we look at it, to hold on to your buildings, turn them into castles, raise your rent, tune them up, and really make adjustments for positive cash flow in those assets. Okay. Average construction, we talked about falling. Our deliveries are really going to fall. The office to multi-family conversion, people hype that all the time. 3 to 5% of the times it could work. It almost never does, because huge office does not lend itself as a floor plate to multifamily. By the time you bring up air, water, gas, stairs, elevators, and all those vertical penetrations in the building, no one wants to live on the inside of that kind of building. So a lot of times the best thing is take it down and start over. And what I say there is, even with retail and old office, the next occupant may be a bulldozer, and that's happening as well. Okay. From a cap rate, we're seeing 4, high-end units, some trading below 5% cap rates, thinking of you, Southern California, Manhattan, chunks of Florida. So really aggressive buyers. And a lot of times that's foreign capital coming to us with a really low cost of funds. So we have almost nothing there. When we look at our pricing trends per unit, we're seeing a change at 213, not a bad number. 2022, that peaked at 252. So we're talking about a 21% discount from peak pricing in 3 years. That's a huge opportunity gap to get in. So if you do have an asset on market that you can acquire at that number, you're getting a 20+% off peak pricing. That's a cool opportunity, especially when I know they're not building new ones around me and I can be aggressive on rent increases. So if you're out there looking, watch that average price per unit. You might be surprised where opportunity still is there, right? The most aggressive place we're seeing rent growth is in the 1 and 2 star properties, more so than the higher end ones, because they're still trying to entice people into fairly high end properties. They're hoping people will get in, settle, and be like, hey, this is really great to live with the amenities and the Starbucks in the basement, in car park, in building parking and a workout center, as opposed to everything's on the street. So our top rent growth market, San Francisco, 6.9%. Crazy. Chicago and San Jose, 3.8, 4.2. Rent declines, Austin, -4.1, Sarasota, -5, Denver, San Antonio, Phoenix, -2 to 3.7. Some really challenges there. Real challenges there, which is surprising to see. Rent growth, they say will recover nationally to 1 point something%. I think it's going to be out there a little bit. Okay. So where's your opportunity? I like going into headwind markets and getting opportunities there. San Antonio and Austin, vacancies 14.5, 14.7. Big vacancy for oil country and Texas, which has been a hot market for so long. Their vacancy or their rent growth -2.3 and -4.1 respectively. Those are tough numbers for people who bought buildings on pro formas a few years ago and may now be facing their debt resetting. There's opportunity. We look at Denver, 11.5% vacancy, -3.1% rent growth. A huge delivery glut, and it's not being absorbed as quickly as it could. Okay. So what do we look at? Our target, if you had capital and go, what should I do in this market? Find your value adds, take an A to a B or a C to a B to an A if you can, in terms of like upgrading the quality of your asset. Rehab, push your rents. You will be rewarded for doing so. Midwestern, Northeast markets have positive rent growth. Some of the more sunny areas are struggling a little more than they would you'd expect, especially with retail going on and following that. Because retail is really hot down there, but some of those central and Northeast markets are doing really, really well. Over leveraged Class A assets are the number one risk factor out there, built on spec and pro forma. And don't worry, we hope it goes well. Not all is going as well. So there's some risk there. If something looks too good to be good, it's true. Too good to be true, it is. So don't fall into that trap. Watch the big risks too, as far as population growth and things like that. You can't quite control that, but operationally, you can absolutely control your rent growth, being sure you're on top of unit condition. Energy efficiency is becoming more and more important as energy costs spike as well. So a tale of a couple markets, but definitely some good opportunity. I love it. Again, there's a real big pullback in construction there because that bodes incredibly well for the health of the market for the next several years in multifamily. So thank you for joining me for our multifamily outlook. I appreciate your time. If you have questions on this report, please reach out to me or any of our EXP commercial advisors. We're in every market in the country and happy to help. If you are an EXP advisor and have questions on this, please reach out to me or the operations team. We're always happy to help any way we can as well. Thanks again for joining me for our multifamily update. Look forward to talking soon.